Okay, good afternoon. It's Peter Klein, Chief Investment Officer, co-founder, Align Wealth, with you this rainy Sunday afternoon on the 29th of September. Trying to get this video in for distribution tomorrow, Monday the 30th, the last day of September, and the last day of the third quarter of 2024. Hoping you folks are staying dry in the eastern seaboard of America here with the aftermaths of the storm down south, and our hearts go out to those impacted down there. It was a massive storm. Okay, so allow me to share the screen, providing some contexts to what we're thinking at Align Wealth as it relates to markets, as it relates to investment opportunities, risk tolerances, a whole ball of wax. So let's get right into it. I'm going to share the screen. Here we go. Okay, you see, of course, our typical winding road, the life's challenges, financial challenges through one's financial life. We're at Align Wealth, where our job is to help you navigate those twists and turns and make a straight line, so to speak, from start to finish. So we're your co-pilots, and we welcome that responsibility and take it fully on as we help our clients steward the twists and turns of their financial lives, and as markets as well. Okay, next, the macro backdrop. Okay, folks, let's talk about inflation. Clearly, that's the big deal right now from a macro standpoint, right? We've had this, good 6, 7 months since the early part of the spring of decreasing or better inflation numbers. What that means is less growth a quarter, month to month of inflation. Doesn't mean prices are coming down, right? That's deflation. It means that the rate of change is not as much. Okay. And so understand that issue. Prices are still up from where they were a few years back. That's nature of inflation. Remember, previously to that, we had a bout of deflation, which everyone got fairly addicted to, especially in the bond markets, and ever decreasing or zero interest rates. That's not today. Today, we're coming off of that string of increasing month-to-month inflation. The rate of change was increasing, and now it's not as much. However, it is our thinking that the inflation toothpaste is not easy to get back in the tube. Okay, and here are the five reasons why we believe that is the case. First is money supply. If you believe, as many monetarists do, that inflation is essentially an expression of money supply growth, well, money supply growth since 2020 is up 36%, and CPI is up 22%, which would suggest we've got some room to go on inflation. So that's the first thing. Let's call that the strict monetarist thinking. Now, deficit spending is also part of that mix. I say here that Washington, D.C., seems to be laughing at the bond vigilantes. Allow me to unpack that. Let's go back 25 years ago, Clinton administration. There was this concept called the bond vigilantes, which essentially are the most powerful bond market investors, the participants in the bond market on the institutional side. Think, huge pension plans, huge insurance company portfolios, big buyers of bonds. And they had gone at the time to the Treasury Department and pretty much said to them, hey, we don't feel like we're getting our just return for the risks that we're taking in buying your treasuries, your bonds. Ergo, we want a greater return for that risk. And that's the power of the bond vigilantes, right? And there was a quip by that political pundit who said that he wants to come back as a bond investor in his second life because they're so powerful, right? Because they're able to move institutions like the Treasury. And essentially, that's what we're thinking about here when we think about deficit spending and debt levels, right? We're thinking about this notion that, hey, we're spending a lot of money that we don't have. We got a lot of debt, and yet interest rates are laughable at the current level. And what does that mean? Will bond vigilantes come out of hibernation and essentially say to the United States Treasury and the credit markets, and pretty much say, hey, we don't think we're getting a good return for the risks we're taking, given the current situation with your balance sheet. Number three, inflation potential, a second wave. Historically, that does happen, by the way. Historically, there has been a second wave of inflation. Many countries that we examined, many different, over 60, 70 years, you've seen that, 99% of the time, you've seen that second wave of inflation. So I didn't even put down the historical context here, but that is one of the reasons to consider potential second wave. Deglobalization is one of the bigger ones in my book. In a complex, once efficient supply chain world where you were able to arbitrage different labor costs and different supply chains to get the lowest costs, you're not getting that in this hot geopolitical environment. So deglobalization, we have two wars going on, maybe even a third, and it doesn't look like it's stopping. And so this is something that one cannot ignore, and I do believe it can become part and parcel to getting that, having a difficult time getting that inflation genie back in the bottle or toothpaste in the tube. Okay, decarbonization. Uh, Listen, I'm all for saving the earth. We only got one of them, and I get it, and I'm all for it, but it is going to be wildly expensive. Do not think differently. We don't have the copper, the aluminum, the needed materials and metals because we didn't invest in the supplies of those back 20 years, or in the last 20 years, when no one cared. And now we're sort of looking at increasing demand without having the required important supply. And by the way, you just can't turn that switch on so quickly and boom, you got copper. It takes years and lots of permits and lots of issues to get a new mine up and running and get that supply that's going to be needed to decarbonize the world. And lastly, immigration. The immigration policies clearly have impact on labor and housing and the like. So this is why we're thinking, hey, wait a minute, we don't think this inflation sort of is sort of over. Not going to say it's going to be hyper, but for these reasons and the historic one, we do think it's likely to potentially come back. So, okay, next slide. And again, this is part and parcel to that deficit spending piece. We have 36, this is 34, this is a couple of months ago, $36 trillion. Every 6 months, it seems to go up a trillion. $36 trillion of debt. And it's now the servicing of that debt is no longer, forget, I don't care, it's zero interest rates, no one cares. It's now substantial. It's so much so that it's equal to the spending on military, right? So $1 trillion. So sure, the recent bond market rally and reduction of current interest rates a bit certainly might have some impact. If they go lower, they stay low. But clearly, we're not to the ZIRP, zero interest rate policy period of 10, 15 years ago. And to that end, this debt is a substantial headache. And in my view and others, it is likely to be where the next financial crisis lives. So let us make sure we understand that, and let us make sure that we don't ignore the fact, and you've heard me say this time and time again. So, if you think about it, that's one of the big things we've been talking about at Align Wealth is the issue of our debt levels. Okay. Opportunities and market internals. I like this slide from our friends at Van Eck. Speaks to the issue that the S&P 500 is not always the winner in every period, right? Let's go back to 96 to 2000. Of course, that was the dot-com period. By the way, that was the only time we've had a balanced budget and a surplus, which quickly went away. And so you see there the Nasdaq, sort of killing it majorly during that bubble period of internet, and kind of exciting in the sense that it was a new technology, right? And had such an impact for so many industries and for so many people and investors. But clearly, I guess in retrospect, clearly a bubble, right? That's what the 2002, I guess, market um, had came off of. So you could see those numbers there. And look at how emerging markets, had really did nothing in those periods. It was all Nasdaq, right? Going forward, that this is sort of that lost decade, right? Where here's the S&P 500 that was sort of was flat. Interestingly, the equally weighted index, not so much, because again, concentration within the S&P cap weighted index was such that the biggest companies, the ones that were in the tech field at the time, again, rhymes, who knows, didn't do well. Their multiples collapsed. I mean, major companies, I'm not going to name the companies, but major companies that you would know, they did everything they were supposed to do. They grew their earnings, they grew their cash flow. It was, for that period, they did what they were supposed to do, but their multiple, and when the multiple goes down, your stock price goes down. And so, because the multiple was so high, and that's the thing, right? It's kind of thinking about today in a way. But so the equally weighted index did better in this sort of lost decade than the S&P did. So diversification made sense, and international came, especially emerging, came alive here big time. 2014 to the current period, we see the S&P, the cap weighted into S&P still dominant, the Nasdaq dominant, equally weighted. Everything is pretty much up except look at this, emerging markets. They've done nothing. I mean, for a while. So that's interesting to me. And look at developed markets too. They really haven't done anything. So this is where I think some opportunity might be coming about. In fact, if you look at this chart, which is the chart that shows you the various different winners each year, if you will, it has been, you could see year after year, United States, United States, United States. Listen, I drink at the font of American exceptionalism just like you do. I mean, of course, we are the greatest nation, and we have the greatest laws and we have the greatest economy. I get it. But there's a point to where investors, fiduciary centric investors, have to say to themselves, is the value there? Can I make sense of the cost versus the return? And are there other spots that have been overlooked and ergo opportunistic because they've been overlooked? That's what a good investor does. And to that end, let's talk about diversification. This shows you the MSCI US index in orange, and you can see how the top 7 holdings is nearly 30% of the portfolio. We know the companies; they're sort of essentially listed here, and you can see it's 30%, right? If you look at the MSCI All Country ex-US, rest of the world, ROW, right? It's 10%. So 3 times more concentrated is the United States market to its ROW, the rest of the world. And if that is the case, that is the case, and therefore one has to think, does that mean that the US is more risky because it's less diversified? I mean, that's what we're taught in grad school, right? That's the first class that they teach us in finances. Diversification is the way to reduce risk. That was a Nobel Prize winning work of Harry Markowitz back in 1952. And so, if that's the case, well, then it's pretty evident that the United States would be considered more risky because it's less diversified. The pushback to that is that these great companies, these mega cap companies, are such, they have fortress balance sheets and they're so dominant and their cash flows are so consistent that they will be able to withstand anything thrown at them. And therefore, they're not risky. Okay. But then there are things like competition that does come in. Hey, it's hundreds of young people and smart people in garages in Silicon Valley and around the world thinking of the next greatest app. So let us not think that because they're dominant today, they'll be dominant 10 years from now. Okay, growth is not the only way to make money. In fact, value, the value style of investing, buying cheap stocks with a margin of safety rather than buying expensive stocks and hope for further growth, did very well in the 21-22 period versus growth, as shown here. This is US, and then this is ACWI ex-US, and this is emerging markets. So this was all value. This was a value run that we had a couple of years ago. Uh-huh. And inflation was part of that, by the way, because value stocks typically do better or growth does not do as well when interest rates are going up. Now, interestingly, the rest of the world, international, ex-US, and emerging, have not had the resurgence of growth versus value as the United States has had. And then maybe you could say this is AI infused. That's what I would think that blue box would be. So I showed this to you to give you a sense that value they're long over long periods of time. Their value style of investing, or as evident in great investors like Warren Buffett, has certainly have done very well for investors. It's just that growth has been on such a tear in the last year and a half, likely due to AI in some extent. Okay. Next slide. Boom, right? Okay. What you pay for an investment, the multiple, right? The multiple to earnings or multiple to book value or multiple to cash flow, the multiple is the most important factor to long-term success. So it's not just, who's in Washington or who, what, the tax policies or the revenue growth or who's got the, greatest management team. Value, it's been shown the most important factor is valuation, is what you pay when you buy an investment, be it in a home or a business or a stock or a fund. And this shows you that the rest of the world, ACWI ex-US, is super cheap. Look at it versus the United States. I mean, it's almost half. Price to book is more than half. So, we've got to think about this important stuff. That's what we do because we're fiduciaries and we're people who care about our clients' assets and the growth of those assets, how we're going to do it in the best way. So we study a lot, we read a lot, we work these numbers, and we talk to a lot of people to figure out what's going on. We just don't chase the hot dot. That's not what we do. What we do is look where the puck is going, I guess you could say, rather than where it's been. Okay. And again, I show this again because valuations are that important. This shows you the relationship between interest rates and valuation. And if interest rates are way low, as it had been, in the bubble period of, let's call it the last 10, 15 years when interest rates were so super low, you could see lots of, where the PE can be much higher. But if interest rates are somewhere in this level, you can't, you're not going to be able to deal with an high teen multiple. You really need a lower multiple. That's where these blue dots are. So we have to realize how the interplay between interest rates and PE multiples. And this again is just showing you how other countries across the world are trading at deep discounts versus the United States. And therefore, I would suggest that they would be opportunistic because of that. Back to the US, although this can be applicable to the rest of the world as well, dividend growers are a special category of companies. These are companies that have increased their dividends consistently for 20, 30 years. Boom, boom, every year. right? These are solid businesses. Many of them are not sexy. Many of them are not something you'd hear about or know about, companies you may not even know. But as this chart suggests, for 23-year data, the returns are higher, the risks are lower. That's the golden place to be, kids. That's where you want to be. Lower risk, higher return. But you don't get there easily. You got to do the work. You got to roll up the sleeves. You got to read the 10Ks and 10Qs. You got to go on to conference calls. You got to read the analysis reports. You got to do the work. That's how you find them. And that's what we do. Okay, but if you think comprehensive fiduciary centric wealth management is more than just knowing the markets, it is. And it's not just that, right? It's not just knowing the market, although we spend a lot of time on that. We spend a lot of time also on our clients. And we put together this little sort of equation to explain how we think of that. What is wealth management? Well, of course, it's this investment consulting piece that we've talked about. This is the investment, chief investment officer's video. So of course I'm going to be talking about where we are in the markets and the current conditions and what we think is interesting. But unless you think that's all we do, no, it isn't. We spend a lot of time understanding the planning that goes into our clients, but what wealth enhancement is, cash flow and tax efficiency, wealth transfer, ensuring that the assets are titled properly and the beneficiary papers are on file and the estate plans in order, the legacy plan perhaps as well, making sure our clients' wealth is protected. So all of this is part of the comprehensive wealth management piece that we spend a lot of time and effort on at Align Wealth. That's what we do. Proactive empathy, understanding our clients. And this is that last piece right here, understanding what makes our clients tick, understanding what their risk tolerance might be, even though they may think it's something different. We have to talk that out with them. Remind them how they felt the last time the markets were in turmoil. Were they able to handle that, that sort of agita, right? And so this is what a good wealth manager does is they're proactively empathetic. They understand their clients. They're consistent with their messaging. They are responsive and they communicate and they collaborate with the CPAs, with the attorneys, the other bankers, perhaps. This is what wealth management is in its totality from a fiduciary centric perspective. I hope that helps. We're here to help. Thank you for your time today. If you're in the New York area, stay dry, and we'll talk to you soon. Thanks again.